There's a question that sits beneath every rule a serious trader ever writes down. And most people never ask it plainly. They learn the rule, cut losses, size small, preserve capital, and they follow it or they don't. But they rarely ask what the rule is actually guarding, and because they don't ask that, the rule stays brittle. It holds in calm weather and shatters the moment real pressure arrives, because a rule you follow from habit has no roots, and a rule you follow from understanding is almost impossible to break. So ask it plainly, what are these rules protecting? They are protecting your right to continue. That is the whole of it. Capital is not the scorecard. Capital is the permission slip, the thing that says you may remain at the table and take the next trade and the one after that and the one after that, until the odds that genuinely favor you have had enough time to express themselves, destroy the capital, and the permission is revoked. It does not matter how sound your judgment was, how correct your reading of the market, how close you came. If you are not at the table when the trade pays, the edge might as well not exist. An edge is a claim on a long series of outcomes. Remove yourself from the series early and the claim expires unpaid, regardless of what happens next. This is the thing most people get wrong in the early years, and some people get wrong for the whole of their careers. They think the goal of any given trade is to be right. It is not. The goal of any given trade is to still be trading when the next one arrives. Being right is a distant second. A man who is right and then wiped out leaves the market with nothing but a story. A man who is wrong takes his loss cleanly, preserves his capital, and returns the next morning has lost a small amount of money and gained an enormous amount of future. Think about what it actually means to have capital and no open position. It means you can afford to wait. You are not under pressure to act. You can sit with your hands folded until the situation clarifies itself into something obvious, something that has the weight of the evidence behind it, something where you are not guessing but observing. That is an extraordinary luxury, and it is one that most market participants never experience because they are always in something, always committed, always hoping the current position comes good before they need the money for the next one. The man who is fully committed and short on capital has only one option left to him, which is to be right about what he is already holding. That is not trading, that is praying. Every dollar risked in a trade is a dollar that cannot be risked in a better trade next week. This sounds obvious, and it is, but the full weight of it takes time to settle. It means that every trade is a choice, not only about the current opportunity, but about every opportunity that will follow it. Sizing a position recklessly is not just a mistake about this trade, it is a mistake about every future trade that capital could have funded. The decision about how much to risk is, in that sense, the most consequential decision in the sequence, more consequential than the entry price, more consequential than the exit, because it determines whether you are still present when the later decisions need to be made. Jesse Livermore understood this in a way that shaped everything about how he operated. He knew that being in the market and being in the game were two different things. The market would take almost anyone. The game, the long game, the one where you survive long enough for your judgment to compound, that was reserved for those who treated capital as something to be protected with the same seriousness that a craftsman treats his tools. Spend the tools and you cannot do the work. There is nothing sentimental about it. It is simply arithmetic. What the rules are protecting then is the series itself, the chance to keep showing up, the chance to be present when your method, your patience, your reading of the situation finally meets the conditions that reward it. You cannot be paid on a trade you are not alive to take. The rules exist to keep you alive to take it. Most people think the rules of trading exist to prevent losses. That is not quite right. The rules exist to prevent a specific kind of loss, the permanent structural kind that ends the enterprise entirely. A losing trade is ordinary. A depleted account is a verdict. The distinction between the two is the whole game, and most people never make it clearly enough to act on it. Here's the thing about position sizing that almost nobody understands until they have been humbled by it. It is not a risk management technique. It is a definition of what being wrong costs you, and that definition is yours to write before the trade begins, and only before the trade begins. Once you are in, the arithmetic is already settled. You are watching a sequence of events play out according to the numbers you agreed to at entry. The only honest question at the moment of entry is, if this trade goes wrong immediately, what does that cost me? And the only honest answer must be one you can absorb without distress, without changing your thinking, without being pushed into any decision other than the one the thesis demands. The amateur, when he is confident, sizes large. He treats conviction as a reason to press. This is one of the most natural and most ruinous instincts in speculation, because conviction and correctness are not the same thing. A man can be absolutely certain and absolutely wrong simultaneously, and the market will not adjust the outcome to honor his certainty. What the professional understands, and this takes time to truly internalize, not just to know, is that size should be calibrated not to the strength of the belief, but to the likelihood of error. The stronger the feeling, the more worth asking, what would it mean if I am wrong here? What would it cost, and can I absorb it and continue? Size the position so that being wrong costs you something you notice, but not something you cannot recover from by the following week. That is a practical rule, not a conservative one. It is what allows you to make the same quality of decision in the next trade that you made in this one, because your judgment has not been rattled, your account has not been torn open, and your thinking is still clear. The professional is not protecting himself from loss. He is protecting the quality of the next decision and the one after that, all the way out across a long series of trades where the edge eventually pays. There is a version of sizing that looks like courage and is actually a kind of impatience. It says, I am so right about this that I should be paid in full at once. It loads heavily into one idea on one occasion because the feeling of certainty is high. But a single trade, no matter how sound, is not the series. It is one observation in a long experiment. Skew the stakes of that one observation high enough and you can distort the entire experiment. You can be correct more often than not and still lose simply because the occasions when you were wrong happen to be sized large. The outcomes of individual trades are not yours to control. The sizes are. That is where the discipline actually lives. Now, there is a doubt worth sitting with. Someone always raises it. They say, surely there are moments of such obvious opportunity that pressing harder is rational. And the answer is yes, tentatively, but the bar is higher than most people set it. And the danger is not that the principle is wrong. It is that nearly every trader believes he is in the exceptional moment far more often than the exceptional moment actually arrives. The bias runs one direction. We overestimate clarity and underestimate randomness, especially in the moments that feel most electric. Jesse Livermore spoke of waiting for the pivotal point, the moment where the line of least resistance was unmistakable, and even then, he counseled probing rather than plunging, testing the water before committing the full weight of capital. The point is that sizing up is a response to demonstrated evidence, not to feeling. When the market confirms the thesis, you may have reason to add. When the thesis is still only in your head, you do not. The practical consequence of getting this wrong is not just a larger loss on one trade. It is that a large loss forces you into a different psychology for every trade that follows. You are no longer deciding from a position of sufficiency. You are deciding from a position of deficit, and deficit thinking is poison thinking. It reaches for recovery rather than opportunity. It mistakes speed for repair. A man who has lost a third of his capital in a single trade is not the same trader he was before that trade. His math has changed, his confidence has changed, and most importantly, the quality of attention he can bring to the next genuine opportunity has changed. He is watching the wrong thing now. He's watching his own wound. That is the invisible cost of an oversized loss, and it does not show up in the trade journal as a separate entry. The rule, then, is not cautious. It is precise. Know the number before you enter. Write it down if that is what it takes. Let that number be small enough that being wrong is an event in the sequence, not an event that ends the sequence. The game is long. Stay solvent enough to see the next turn and the one after that. Every position you survive is another position you are eligible to take. Every one that takes you out of the game forecloses all of them. The first loss is the smallest check the market will ever write you on that trade. Every session you hold a losing position, you are not waiting for a recovery. You are inviting the market to enlarge the bill. And the market is patient. It will sit there and keep enlarging it for as long as you allow. Most people understand this in the abstract. They nod at it. They have heard it enough times that it sounds obvious. And then a trade goes wrong and they do not exit because the loss is not yet real to them in the way it needs to be. They are still inside the original reasoning. The stock fell, yes, but the thesis is intact, or so they tell themselves. The earnings are still coming. The sector is still turning. The position is underwater, but the argument is not yet defeated. This is where the damage begins. Not in the loss itself, but in the story that replaces it. The moment a trader stops responding to the market and starts defending a position against it, he has changed his job without noticing. He is no longer a trader. He is a litigant arguing his case against a judge who does not read briefs and does not care about your reasoning. The market will not rule in your favor because your analysis was thorough. The correct rule is simple to state and brutal to follow. Step out of the trade the moment it steps out of the thesis, not when it reaches some arbitrary number below your entry. The moment the condition that justified the trade is no longer present, the trade is over. Price is evidence, but it is not the only evidence. If the sector leadership reverses and your position was predicated on that leadership, you are already wrong, even if the price has not finished telling you so. A trader who waits for the price to confirm what the tape has already told him is paying extra for information he already received. Now, many traders hear this and conclude that the solution is to set a stop loss and walk away. And a stop loss is not nothing. It is better than nothing. But it is not the whole answer, and treating it as the whole answer creates its own failure. A mechanical stop set at some fixed percentage below entry is not a stop that respects the structure of the trade. It is a stop that respects your feelings about how much you are willing to lose. Those are different things. The right exit is defined by the trade itself, by what would have to be true about the market for you to have been wrong, and it should be determined before you enter, when you are still cold-blooded, not after, when you are already invested. The harder failure is averaging down. There is a particular appeal to it. The logic feels sound. The stock is cheaper than it was. You believed in it at a higher price, so surely you should believe in it more at a lower one. But this logic contains a hidden premise that most people never examine, that the original analysis was correct and the price movement is the error. Sometimes that is true, often it is not. And the problem is that you cannot tell the difference from inside a losing position, because a losing position is not a neutral vantage point. It is a distorting one. It makes you argue when you should be listening. Livermore came to this rule the hardest possible way, by breaking it enough times and paying enough for it, that the lesson finally stuck. His principle was not to take the first loss out of timidity, but out of recognition. The market was already telling him something, and the cost of ignoring it compounds. He never added to a loser, not because it was never theoretically justified, but because he understood what it does to judgment. You cannot think clearly about a position you are desperate to save. There is a distinction worth making between a loss taken correctly and a loss that takes you. The first is an expense, no different in kind from any other cost of doing business. It belongs in the same category as the overhead of staying in the trade at all. It is paid and it is done. The second kind is what happens when you do not take the first kind. It grows until it is no longer a bad trade but a bad month. and then no longer a bad month, but a bad year, and eventually it is not a year at all. It is a question of whether you are still in the game. A loss treated as a wound is the most dangerous thing in trading, because a wound makes you want to recover. It makes you impatient and aggressive and unselective. You stop trading the market in front of you and start trading against the memory of what you lost. Every subsequent trade carries that freight. You are no longer asking what the market is offering. You are asking what it owes you, and the market owes you nothing. It has no memory of your loss and no obligation to make it right. There is also the question of liquidity, the risk you can exit versus the risk you cannot. Most discussions of loss assume an orderly market, a willing buyer on the other side, a price that moves against you but can still be acted on. That is not always the world you are trading in. Thin sessions, halted stocks, liquid markets in moments of stress. These are the conditions under which a manageable loss becomes an unmanageable one, not because your analysis changed, but because the exit closed. Size and selection both speak to this. A position you cannot get out of at need is not a position, it is a trap, and the depth of it is determined by conditions you did not create and cannot control. The only control you had was before you entered. So the rule is not merely to cut losses, the rule is to cut them while you still can, while the market still offers you the price, while the cost is still what you agreed to pay when you loaded the trade. Waiting for confirmation that you are wrong costs exactly the difference between what you would have paid then and what you are paying now. That difference is the price of hope, and hope in a losing position is consistently the most expensive thing you can buy. Here is section 4. Most people who abandon a method do so at precisely the wrong moment, not because they are foolish, but because the moment a method feels broken is almost always the moment it is about to work. The pain arrives first, the vindication arrives later, if you are still there to receive it. And so the question of whether your rules are working is not a casual one. It is, in fact, the most dangerous question you will ask yourself in this business, because the circumstances in which you ask it are almost always the circumstances least suited to answering it clearly. The first error is measuring by the wrong unit entirely. A trader finishes a rough stretch and asks how many trades he lost. The wrong question. The market does not pay for trades won. It pays for capital compounded over time. You could win 6 trades out of 10 and finish the year behind if the 4 you lost were sized recklessly and the 6 you won were sized with timidity. The scorecard that matters is the one denominated in money, not in outcomes, and the time frame that matters is long enough for the method to breathe. Judging a sound method by a month is like judging the soil by a single morning. You will make decisions based on weather that has nothing to do with the crop. The second error is subtler and more expensive. It is the failure to decide in advance what broken actually looks like. Every trader believes he will know it when he sees it. He will not. When the losses are fresh and the confidence is shaken, the mind is entirely capable of mistaking a bad patch for a structural failure, and equally capable of mistaking a structural failure for a bad patch. These are opposite mistakes, and both are available to you at the same moment, which is why you cannot trust yourself to make the call in real time unless you already made it earlier in writing when you were calm. Write it down before the losing run begins. What specific thing would tell you the method has stopped working? Not a feeling, not a count of consecutive losses. Something concrete, a rule you cannot apply without ambiguity, a market condition the method was never designed for, an edge you can no longer describe to yourself in a single sentence without adding qualifications. If you cannot name the edge clearly when things are going well, you will certainly not be able to name it when things are going badly, and you will be vulnerable to every passing explanation a bad month wants to offer you. There is a practical test worth applying when the doubt arrives. Look at the current drawdown against every drawdown the method has already survived. If this one is no deeper than the worst already on record, it is not evidence of anything except that markets are uncertain, which you knew before you started. Sit with it. change nothing. The method has already lived through conditions as bad as these and recovered, and you have no new information that would change that calculus. But if the drawdown exceeds every prior one by a meaningful margin, that is a different question, and it deserves a genuine answer. Not a panicked response, but a genuine inquiry. What changed? When did it change? And is the thing that changed the thing your method depends on? Those are the questions worth asking. The number of losing days is not on the list. What you must guard against most fiercely is the change made in pain. A method altered under the pressure of a bad run is not a revised method, it is a retreat. And a retreat made under fire rarely lands you in a better position. It usually lands you in no position at all because you have now abandoned the discipline you had without yet acquiring a new one, and you are operating in the gap between them with live capital at risk. Do that twice in the same year, and you will find you own no method, only a record of the moments you could not stand still. The seasoned trader understands that sitting through a losing stretch inside a sound method is one of the most productive things he can do, because it is precisely what his less disciplined competition will refuse to do. When they quit, the edge they were competing against him for goes with them. The man who survives the drawdown intact, capital and method both undisturbed, is positioned to receive exactly what the quitters left on the table. This is not romantic. It is arithmetic. The advantage compounds not from being clever in the good stretches, but from not destroying yourself in the bad ones. Jesse Livermore understood this as well as any man who ever traded. He observed that the big money was never made in the thinking, but in the sitting. Not sitting idle, but sitting through the discomfort of a position that has not yet paid, or through the discomfort of a method that has not yet been vindicated, with the patience of a man who has done the work and trusts the result. That trust is not blind. It is specific. It is earned by the preparation done before the pressure arrived. And it is the thing most traders never develop because they are too busy changing their approach every time the market challenges it. No method owes you a profitable month. What it owes you, if you apply it with consistency and discipline, is a fair accounting across a full cycle. The man who demands payment on a shorter schedule will quit during the very stretch that was about to pay him, and he will never know it. He will only know that he tried and it did not work, and he will be wrong about that for the rest of his life. There is no asphalt boulevard to success in Wall Street or anywhere else. Why additionally block traffic? The market rewards the few who stand apart. Find the tape at charthorizon.com.